following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
Good morning, everyone. I'd like to thank you all for being here this morning and getting up and making the early morning panel. It's always a difficult one, I know that. And thank you again to OIC, FIA for putting this on, and all the sponsors as well. It's a great event, and as Gina mentioned, we've got the attendance, a climbing attendance versus what we've seen in a lot of the other pieces of this market with things decreasing. We've got an esteemed panel with us here this morning, and the way we're going to organize this a little bit is going to be a little different than a lot of panels. I know FIA has done a few of these before, where what we'll do is we've got our media participants, Mark Longo and Nina Mehta here, who will be asking most of the questions. My job is really to act as more of a game show host, although I couldn't find an outfit. I think they're all in Omaha. But we'll see if we can't get to keep things rolling. We've got a fair amount of time here, and we will save some time at the end for the audience questions. What we're going to touch on is a lot of the different topics, and we want to really address what's going on in the markets today. And Gina had mentioned and talked about volume a little bit, and while volume seems somewhat dismal, it's really not, particularly in the options business, with 2011 being probably on track to be the second best year in volume, with 11 being more of a little bit of an anomaly due to the market conditions. So things are hopefully shaping up. The question is, are we still able? Is there still enough profitable trading? With volatility down and things like that, it's difficult, and that's where a lot of that support of the markets comes from, and then it's got to do with the regulatory structure as well as responsibility of all the participants of the marketplace. So we'll touch on that. We'd also like to touch on the evolution of the markets with a bit of a concentration on the exchange space and what exchanges were, what they've come to, and that's what we'll use our panelists to really dig into. I think that'll be a big part of this today. And then, as I mentioned, the responsibility of the participants in exchanges to the marketplace, and how our job is to use the tools we've got to make certain that the participants don't feel that they're trading in an unfair market or something that isn't profitable for them, or they're not getting proper access to it, which seems to be a very strong theme out there today, particularly on the buy side. And retail, as we know, can certainly step back, and when they step back, they just goes into managed money, which turns into the buy side, and that's always how the money kind of flows. And then another piece of it is the obligations and rewards to the participants. So we want obligations from all the participants into the marketplace, particularly the liquidity side. But at the same time, do we have the proper tools in place to reward them for those obligations? And that's, I think, a very important part. We've gotten away from a lot of that, and it may be time to get back to that. And then we'll touch on a little bit of regulation, the perception in the market, as I mentioned, kind of the buy side, retail, not feeling maybe that they're trading in an unfair environment. And a lot of that comes from some of the market events. We've seen everything all the way back to Madoff, then we see the MF Global type stuff, we see the erroneous trade things going on. So we want to make sure that we think about that a little bit too. And I know this is on everyone's mind, and hopefully we can get some clarity from our panelists here. So to get things rolling, I think we'll try to at least engage the audience a little. So we're going to do a quick little raise of hands. Now, this isn't to see who's Democratic or Republican. It's more about who do you think will be in the White House after our election here. Who thinks that, and remember, who thinks that President Obama will end up back in the White House? It looks like a pretty strong showing. Okay, how about who thinks Mitt Romney will make it to the White House? Wow, you guys don't have to. Everybody please vote the opposite of the way you raised your hands. Who wishes we had who wishes we had another candidate? There we go. Okay, so the current environment we're in. More exchanges. We continue to expand on our exchanges. We've actually talked about that on a lot of panels. We've talked about that an awful lot. And, maybe it's not so much about the number of exchanges, but the structure of the markets and why there's more exchanges. The lower volume levels, again, not so much in the equity market, but some of our capital markets in general. The interesting part is market capitalization is at all-time records, yet volumes are down. Why, what's going on there a little bit? Again, we've got global financial turmoil and everything else, but it's not all bad. We do see some recovery coming. We're seeing housing recovering, although we're not seeing incomes recovering at the same rate. So markets are turning for us. So to start off, we'll go to our the evolution of our markets and the changes over the last 10 to 15 years. We've really gone from exchanges being a membership-owned organization to a for-profit entities, and how that evolution has started. So I'll start with, and I suppose I should have introduced all the panelists, and I apologize, I didn't. So we've got Steve Crutchfield from the New York Stock Exchange, Lisa Falls sitting next to him from the Box Markets, Boris Ilyevsky from the International Securities Exchange, Jeromee Johnson from BATS Markets, Ed Provost from the CBOE, and Walt down there in the end from the NASDAQ Philly.
I get the short shrift at the end of the table.
There you go. So let's, from there, we'll take it, and I'll let Mark and Nina start off with questions, so feel free.
Thanks, Ed. And as Ed said, these panels in the past have focused a lot on the number of exchanges, whether there are too many or too few, and what the magic number is. And I don't know about the rest of you, but I've heard enough of that, I think. I think it's time to really scale back the discussion to a more fundamental level and really examine what that means to be an options exchange in the 21st century. You know, there was a time not too long ago when the exchange and the term exchange had a very specific definition, and the exchange itself had a very specific purpose. It was essentially, in many ways, a utility, a not-for-profit utility that provided a core service to the marketplace. Now, fast forward a few years, and we have a number of new participants and existing participants in the marketplace launching new exchanges, not so much to provide that core targeted liquidity, that bedrock purpose of the marketplace, but instead to exploit some economic opportunity in the marketplace. And now this is a radical departure from the fundamental outlook and definition of what an exchange is or was in the options world. And, you know, we're very fortunate at the Options Insider to be able to interact with a very broad array of the options users, retail through institutional, and a growing number of advisors. And I've been hearing an interesting refrain from this audience, and it's been growing, not surprisingly of late, given all the scandals and other things we've seen. They're becoming quite a cynical and a jaded bunch, this options crowd, and they're starting to cast more of a cynical eye toward the exchanges. And they're starting to say, wait a minute, what used to be my agnostic, not-for-profit utility that existed to essentially execute my transactions has now changed to a demutualized for-profit entity. And many of them are coming to us saying, why is that not a conflict of interest here in the 21st century, to have these two essentially opposing masters in the exchange world? So I think we'll start there. A rather weighty topic for very early in the morning, I think, but an interesting one nonetheless. Maybe we'll start with Jeromee. You're the exchange that most recently went public, so we'll give you a chance to dive in first. Why isn't that a conflict of interest for the exchange to essentially have these two masters?
I would have asked.
Went public for all of a minute and a half. So,
we'll give you two, Jeromee.
We were close. So there is a conflict. I think that's actually an okay thing with that conflict, because what you're getting in that for-profit organization is a drive for innovation, a drive for growing the markets, a drive for what do we do to better serve that investing public. If and when there was ever only one exchange, and that exchange was a utility, what's going to push that utility to do the next big thing? You don't have that same sort of incentive. So I've long been on the long side of the number of exchanges. I think we continue to have room for more out there to come in, find a niche of the market that they're going to take off, whether it's 1% or 2% or 3%. If you're going to be able to come in and serve it, that's a good thing.
Is that a jump ball?
Yeah, go ahead.
All right. So, obviously we've been public. CBOE has been public for just over 2 years. We have enjoyed success in terms of servicing our shareholders. We've increased our market share, so obviously our customers are happy. We think we have been in the past and continue to be an innovator in terms of new product. So I don't hear, nor do I believe, that the conflict is really there. But if it is, I think we, and I think the other exchanges as well, have been able to manage that conflict. At the end of the day, to be successful as a publicly held company, you need to return to the shareholders profits. And in order to do that, you need to give the customers or the users of your product exactly what they want. And we think we've been able to do that. So I think the many different structures that exist in the exchange space in terms of them being mutual or demutualized or publicly held is part of the diversity that makes the options exchange space the wonderful structure that it is.
Ed, maybe I can just ask you, how would you spell out what that conflict is as a for-profit company? Do you think it's what Mark has described, or how would you put it?
So the argument, I guess, would be is that you're driven for profits, so you will make compromise in other areas of your business. My position is, if there's a basic conflict there, it hasn't manifested itself in how CBOE operates. So I'm going to say that we don't see any negative ramifications of us being a publicly held, profit-driven organizations in terms of servicing the customers, regulating our marketplace, and developing new product.
Yeah, I mean, competition among exchanges is not a new thing that just emerged when exchanges became for-profit entities, and certainly going back to when new exchanges first with the ISE first entered the market, other exchanges, more established exchanges, moved to try to respond competitively. So I mean the drive for exchanges to compete with each other in various ways isn't really a new phenomenon, and if anything, I think that the sort of, I think as Jeromee alluded to, the profit motive helps to drive innovation and helps to drive competition. When exchanges were member-owned, the members over time realized over many years they built something that was of value, and it was appropriate for them to be able to operate those businesses of value in a for-profit way, subject to still providing the fundamental, and I think this gets Mark, to what you were alluding to, subject to the operating fundamentally in a way that is still for the public good in terms of running a marketplace. I think there are challenges in the current environment that have emerged in recent years. The landscape has changed a lot with the emergence of technology-driven trading and other things, which have really shaken things up over the last decade. I expect we'll talk about that later. But it's important to remember that although we operate for-profit entities, we are an incredibly regulated industry. We can't set price arbitrarily. First of all, we can't, like any industry, we can't act in an anti-competitive way, of course, but we also can't set price in a way that compromises the just and equitable principles of trade. All of our rules and fees are subject to approval or disapproval by the SEC. They're subject to intense periods of public comment and scrutiny, and none of that has changed with the emergence of the exchange holding companies as publicly traded companies. So I think although the transition of exchanges from member-held to for-profit over the last decade has been potentially a major shift in the industry, I think it's important not to overstate the impact of that on the way the exchanges actually operate as market centers.
Maybe we could just, one other area I think would be interesting to cover would be that, so we've got a little bit of a mixture of just how public you are, right? So, Ed, your entire exchange is your core product is options. Walt or Steve or Boris, you're kind of not core product. You're not actually the core product. You're part of a large organization that's an exchange holding company in a lot of ways. So a little different. Lisa, you guys aren't public at all. Jeromee, kind of the same thing right now. So, is there a competitive edge here? Is it a different? Can you guys act a little bit differently? Maybe, Walt, you want to take a crack at that?
I mean, I think we can. I think we have a little different position than Ed, who's CBOE's primary business is options, and they're a public company, whereas the U.S. options and futures business with NASDAQ, we're a business unit within a large multinational company. So I think for us, when we compete, and this is part of the reason we launched a third exchange, is we bring tremendous scale to the table. So, for example, when we launched BX Options, our third options exchange, we kind of believed we could bring some value with that venue and cater to a segment of the market that we thought was underserved. And to do that for us on a pure cash basis was very low, and ongoing operating expenses are de minimis. So I think we're a little different as opposed to a CBOE when it comes to, efficiencies at scale and dexterity, just because we're such a large organization. And then to your earlier point on the responsibilities of our businesses as public companies is obviously we have a responsibility to our shareholders to deliver a reasonable revenue contribution to NASDAQ's EBS. And at the same time, we have a responsibility to the investing public in the markets to regulate. So we kind of within NASDAQ, we're very kind of strict discipline where the regulatory function is really separate and apart from what we're doing on the business side to drive revenue and control expenses. So on a day-to-day basis, we really are detached from the regulatory function. And at NASDAQ, we kind of believe that's appropriate. The business side, myself and, Tom Whitman, head of U.S. options, and the rest of the team should really stay away from that function. That way we kind of mitigate any conflicts.
Now, I'm glad you hit on that, Walt, because that's something I wanted to get to. I think we could just bring it up now since you addressed it. That concept of the conflict of interest and how it perhaps extend to the notion of these for-profit entities, these demutualized entities, also functioning as SROs. So on the one hand, you have a company who has a profit incentive to go out and incentivize order flow from those customers and drive that to their exchange. On the other hand, we have this SRO entity under the same umbrella whose job is to perhaps put some brakes on that and to regulate those same customers and clients that the other half of the business or the other entity of the business is incentivizing. So I think anyone here on the panel and in the audience could see how we're talking about a crisis of customer confidence in this day and age, how anyone on the outside looking in could look at that and say, wow, that is a glaring conflict of interest. How could a demutualized for-profit exchange also function as an SRO? You mentioned the separation at NASDAQ. Maybe that's something we really need to consider across the board here, and perhaps the notion of an exchange also being an SRO, should that be perhaps a mutually exclusive type of arrangement where you have, if you are a for-profit entity, then perhaps the SRO is not in the cards for you. So let's talk about maybe, Steve, we'll start with you for that.
Sure, thanks. I mean, I would just say I think that separation exists to a very large degree across the board already. Our structure, and I expect the structure of all of the exchanges, is the business is separated from regulation. The chief regulatory officer of NYSE Euronext does not report to the CEO of NYSE Euronext. She reports to the regulatory board, which is an independent oversight body, and that's by necessity exactly because of the reasons that you point to. The business obviously has an incentive to go out there and grow the business. On the regulatory side, the responsibility is to ensure that the markets are operating in a fair and orderly manner for all participants. And so regulatory oversight of rule filings, of fee changes, of everything else before they even get to the point of being submitted to the SEC for approval is very strong, and that separation I think perpetuates that. At the same time, I would stress again that irrespective of the motives of the business side accountable for P&L to shareholders, anything that we want to do, from changing the way we operate from a rules perspective to adjusting our fees, we're under the watchful eye of the Commission, who is charged as well as sort of a second layer of oversight with ensuring that the market continues to operate in a way that's fair for all participants. So I think it's important to stress the number of checks and balances that have to be gone through really at every stage. I mean, I said it a minute ago, we're an incredibly regulated business. I don't think there are many other businesses in this country, many of which serve a public good, right? I mean, grocery stores serve a public good. If all the grocery stores shut down overnight, there'd be famine in America. I mean, it would be terrible, right? It's much more serious, actually, than operating the capital markets. You could say the same thing about, wireless phone companies, about ComEd and the energy companies. So there are a wide range of companies that as private businesses perform a vital public good, subject to appropriate levels of regulation and oversight. And I don't inherently see that the conflicts that we have in operating capital markets are any greater than any of those other examples.
Lisa?
At Box, we actually have a facility model where the SRO is owned, has a different ownership structure than our marketplace. We view the exchange, the SRO, as having the license, which gives the marketplace the privilege to do the trading. It kind of makes you have to be regulated, you have to be following your rules in order to have the privilege of trading and making the profits with the trading revenues. So we really feel that the SRO holds the key. It's not vice versa, that the marketplace dictates the regulation. The regulatory body really holds the keys to the castle, for lack of a better term, and the marketplace and the trading has to adhere to that. That also helps with your customers. They want to have confidence in your marketplace. If you have a glitch or they don't feel like you're being regulated properly, or they can maybe get away with something, that might work for a little bit of time, but everyone wants to know what the rules are, wants to know that they're being enforced properly, what the parameters are, and that they'll be enforced consistently. So again, at BOX, we have a different model than I think most of the other exchanges up here, and it's worked well for us for about 3 months, so we'll see how it goes.
If I could just add to that briefly. So CBOE, having begun the business in the early 70s, was the options regulator and continues to have a huge commitment to the regulatory process. And whether or not down the road we, the CBOE and other exchanges, will just be, whether it will be determined that separating those just makes sense, I think the right thing will happen. I think the concern that I would have, and speaking about things that you hear in the industry, is there is concern that options are a unique product. It's the issues regulatorily that regulators have to deal with on options is not like the cash market, not like the futures market. So with all due respect to my good friends at FINRA, who do a fabulous job at managing what they do, my concern is that there is preserved in this industry, with whatever the end result is, a repository of knowledge by regulators about the unique attributes of options, and that options simply not be thrown in with the mindset of the cash product as though it's the same thing. So that's that, and my sense is I would get agreement on this panel, is the area that I would be most concerned about, that the regulation of options is done in a manner that is appropriate for how options are different from the cash.
I don't think anyone thinks that there shouldn't be industry expertise involved in the regulation. Obviously, this is a very specific, a very nuanced product category. It's not, like you said, Ed, the cash equities, which is pretty much the broad purview of most of the regulators. This requires some industry knowledge to really execute that regulatory enforcement. I think the question is if the current structures are appropriate for that. And what Lisa brought up with BOX is an interesting idea. And I've been thinking for a while now, if we've been hearing these refrains collectively here on the media side from our readers and from our listeners who are starting to scratch their chins and say, wait a minute, are these structures appropriate? Is this the appropriate way to proceed? It doesn't take a genius to look down the road a little bit and think perhaps the regulators might come to a similar conclusion, or perhaps an enterprising politician looking to score a few points. So perhaps this is something that the industry could look to now to avoid those types of dire circumstances down the road. And perhaps this is a scenario where perhaps the industry should start investigating what that definition of the exchange is. Maybe in the 21st century, the exchange and the SRO should be under separate ownership structures, and that could be one element of that definition. Perhaps there could be listing requirements, so all entrants in the space have to provide the same broad purview of liquidity across all, not just the at-the-money liquid Googles and Apples, but all the broad illiquid classes across the board. So they're providing that core exchange function. A number of other elements. Perhaps that's a good question here for the panel. If we are looking to revisit that definition of the exchange, what maybe perhaps taking out some of these other elements of the business, like the vendor side, that could be seen as distracting from the core element, the core business of the exchange. What changes can we make now, or should we be considering now, in order to forego someone stepping in and forcing changes on us that perhaps don't fit as well? Maybe Boris, we'll start with you.
I just wanted to go back just a little bit. We at the IC, we've gone, I think, through all of these stages. We started out as a member-owned organization. We demutualized. We were a public company, and now we are part of a larger exchange group that is a public company in Europe. I think we operate in a very similar way to some of the other participants on this panel. We have a very distinct separation between our regulatory function and our business. function. And I think that all of the changes that we went through, all of the changes that the other exchanges went through, have created a very competitive, and I would suggest a very healthy environment among the exchanges. And I think the evidence of the quality of the markets, the liquidity that is in fact available throughout, the breadth of the market participants, the transparency of all the exchanges, I think proves that it's a good model. And I'm not sure that I agree that we need to be questioning as much as we do the definition of exchanges. I think that the real problem that the industry is facing, not really the options industry, but the capital markets industry, the trading industry, is the confidence that the public lacks in the capital markets. And I'm not sure that any of that has to do with the role of equity or equity derivative exchanges.
So there's no changes you think we should make as an industry that could perhaps collectively act to somehow restore that confidence?
No, that's not true. I think that we're all closely working together with our members, with the regulators, to look at some of the recent events and see what we could do to make our systems, our technologies better in order to prevent some of the technical glitches that have occurred in various parts of the market, and also help our participants and their customers protect themselves. And I think that ISE and I'm sure other people on this panel and their organizations are working very diligently to focus on these areas in light of recent events. But I don't know that that's necessarily means that we have to redefine how we regulate, or that the problems that were caused, that have occurred in the market, had anything to do with the structure of the exchanges.
Let me follow up. Let me just ask a different question about the same issue. You're all talking about how the regulatory operations at your company are separate from the business function. So let me ask you, in what areas do they overlap? Like, when do they actually come together? And do you have examples of the kinds of decisions or the sort of challenges you had to face in thinking through some issue that arose where they were both regulatory and business issues? I can think of a few obvious ones. I don't know if you can all address some of those, but maybe we could start with you, Walt.
Yeah, I think when regulation and business overlap, it typically is with new functionality. If you're going to change your market structure, obviously you have the legal side to prepare necessary filings for the SEC. We also need to involve regulatory operations to ensure that you're going to have the proper systems, controls, and tools to regulate the market. So, along those lines, we're looking at some other changes for, enhancing our risk controls of the exchange will involve the regulatory function. I mean, currently we have, I should say regulatory input. Currently we have, for market makers, our different risk parameters. If they have, a quoting issue and a certain symbol, will purge those quotes. And it's something we think is very important. When you're turning around market maker quotations, round trips in terms of 100 micros, or our BX platform around 80 micros, you have to have these kind of risk controls, which we hold true. And then we're also looking at kind of expanding those with guidance from our regulatory team and our legal team to more multi-symbol protections, where if the market maker has an issue in queues, we'll remove them from we'll use PHLX example, the PHLX platform, and they would need human intervention before we let them back in. And we're looking at those, expanding those controls to see if we can have technology where if there's an issue on NOM, a market maker's issue on NOM, and let's say SPY, we'll remove them systemically from BX options and PHLX, and then when they'll come back in would be human interaction. So I think with that, that's an important thing now. It's a hot button issue now for us, and it's also somewhere where we collaborate more with regulation and legal on kind of designing those systems and putting those into practice.
One of the areas, I'm just going to jump in there real quick, because one of the areas that we do see, you mentioned risk controls at the exchanges, and while we're all as an industry rewarded or punished for the, what goes on in this industry, we've got risk controls at every level, right? There's for everything from testing models that are going to go into the market to the exchanges with the risk controls they've got, with a number of back-end ways to pull things out of the market. The problem is when something does go haywire, there's no true harmony amongst all the exchanges. And now we've got something going on in the market, and the exchanges tend to act differently throughout that. They've gotten better at it over the years. It's been a continuing effort. I remember being on I think it was in 2001, being on a committee that was tasked with making the obvious error rule. the same across all exchanges. We haven't gotten there yet. So what's your guys' thought on that about, is there a way, and of course you have to, you need the regulatory support in order to converse to do this. Is there a way to get closer on that? I mean, even with things like limit up, limit down, but options are very different from the equities. We can't make those type of rules as simply as they did in equities.
Yeah, I think, Ed, with the with the blessing of the SEC, I mean, we're competitors, and harmonization is kind of like code word for doing everything the same. People would like the rules all to be the same. They'd like lots of things to be the same, but they want competition, and I think you can achieve a lot of that. And when it gets to taking initiatives collectively to head off some of the snafus that we've seen in the industry, my belief is that over the next year, some of those initiatives will be undertaken collectively with the encouragement of the SEC. I mean, listen, we all have, for the most part, the same customers, right? The biggest liquidity provider on CBOE, I'm going to pretty much guess, is the biggest liquidity provider on every one of these exchanges. So the guy I'm talking to there is the same guy that Boris is talking to, and Steve and the others. So, there's some degree of, through a third party, direct discussions, but I think an industry initiative, whether it's a national market system plan or something less formal than that, is something worth considering. I think we all would love to reduce the likelihood that any of these things could occur in our marketplaces, and I don't think anybody would be unwilling, I'll just speak for myself, we certainly would not be unwilling to be a part of that process.
Did you start out by saying that it was a competitive advantage for you to have different, clearly erroneous execution policies?
No, well, listen, competitive advantage. I mean, every one of us has designed our marketplaces in a somewhat unique way. I mean, we are all trying to create a little mousetrap to get the order flow to come to my exchange and not his exchange. And so to some degree, the differences is what makes us unique and hopefully attractive. So harmonization can, in some circumstances, take away competitive edge. I'm not worried about that in this particular case. Listen, we have various processes at our exchange, and I know the others do as well, to ensure that market makers can make aggressive markets, but if they get hit too many times within certain amounts of time, they can be protected. So some of those things could be deemed competitive, but at the end of the day, I think that the exchanges collectively can participate in an effort to try to ensure that the things that we've seen don't replicate themselves.
If there is interest, as Ed has been saying for the last at least 11 years, in having a uniform erroneous execution policy for exchanges, because that would help market participants, then is the competition that now exists between the exchanges that has perhaps prevented that from happening, is that an example of rivalries preventing something from occurring that would benefit the market?
I'll speak to that briefly. Certainly there's an argument could be made that uniform obvious error rules would be beneficial to market participants in simplifying the process of understanding when an error has in fact occurred. A discussion about having those rules be uniform across exchanges is not something that's happened, recently, to my knowledge. I might argue that there are probably other issues, like one that the Walt was alluding to with respect to risk controls that are perhaps more pressing, and that there's a little bit more of an obvious apparent conflict of interest there. One could argue that although we're all in the long run incented to have appropriate risk controls in place, one exchange might hypothetically unwisely see it as being in their short-term competitive advantage to have fewer risk controls on the grounds that might slow down order handling, for example, and that's a great policy until one day it's a really bad policy. But on the point of obvious errors, to the extent that the industry were interested in having uniform policies, I think that's something that probably, not to speak for everyone up here, but probably many of us, I think, would support. At the same time, The rules differ and diverge over time because both we have different views, and although I think Ed's point is right that we have in many ways many of the largest clients overlap to a great degree, they're not identical, and the issues that are faced by each exchange because of market structure and other considerations are not identical. There was one exchange, for example, recently that put forward an obvious error policy that used, I believe, the midpoint of the bid-ask spread as the reference price. We looked at that proposed rule and thought that was a bad rule because anytime you had a wide market and somebody lifted the offer or intentionally hit the bid of that wide market, they could then call back 20 minutes later and say they had an obvious error because the market was wide and so the bid or the offer were both quite far from that midpoint reference price. So all the exchanges don't always have the same view on how these things should operate, and sometimes I think that's for good reason.
I'd like to add, it is good to know the rules are published. They're there for everyone to read. I think it is incumbent of our customers to understand each exchange's obvious error rule. So they do, to your earlier point, they should know if there was an obvious error on Box or NYSE. Or they should know, and divergence in the rules isn't necessarily a bad thing. Customers are choosing the marketplace based on what meets their customers' needs. And, you know, these rules are published and very transparent. So I do think there should be a little bit of responsibility on the customer's part to understand what the exchange's rules are.
Maybe we can ask Ed what he thinks, since Ed was part of that committee in 2001 and has been an exchange executive and then a member firm.
I'm not part of the panel. I'm not allowed to answer questions. I'll have to check with my regulatory department to find that out. No, I think that there is everybody did touch on valid points. And, you know, Lisa mentions there's responsibility to other participants in the market. And I think that's very true. But there is perspective that goes into it, as Steve kind of brought up as well, that some exchanges may do something differently because of a competitive advantage, keeps the speed of the system up, things like that. So there's a number of areas there that I think you can improve upon, but much of it may take a little bit of interaction from the regulators to enforce this amongst the participants. And that's also a little bit risky because if you've got a systems capacity issue with one exchange, everybody's systems are a little different, and they say, well, let's do it this way. Maybe it's better for one exchange from a system standpoint than another, and maybe doing it a different way. So there's a lot of give and take there. And we've got a lot of complexity in this market, not only in the product set, but in the number of exchanges we have, particularly in the number of SROs. We've got, you know, 6 participants up here now, but in fact 6 participants are running many more exchanges, and we're going to see that increase as we continue forward. So it is a very complex issue, and I did want to open it up to everybody. I'm not going to, I don't have the answer, I won't pretend to, but it's something I think we should definitely stay focused on and continue down the road of trying to solve.
You know, both Ed and Steve, not you, Ed, but Ed Provost, hit on the competitive advantage aspect of your risk controls and how that could be used in a short-sighted or a beneficial way, depending on your viewpoint. Now, but we're seeing that across the board. And I'm going to go back to my theme. This is my recurring theme of the panel, in case you haven't figured it out yet. But these exchanges, which are these for-profit entities, are aggressively pushing these different technological systems, to the edge, because that is a competitive advantage to have bleeding edge technology in this day and age. But as we've all seen dramatically recently, that there could be downsides to that. And so we have a scenario here where these, like we said, these for-profit demutualized entities, for the most part, if you look at the other participants in the space, the brokerage firms, the trading firms, if their technology makes an error, for the most part, they're eating that. There might be some repercussions there or some remittance, but for the most part, they have liability in that situation. Where at the same time, we have the exchanges, again, these for-profit entities, who are then, when their technology that they're pushing to the envelope, to the limit, when their technology fails, they fall back on the liability protection that was afforded to them when they were essentially utilities, for lack of a better word. And so my question here is that a situation of really having your cake and eating it too? You want to be able to push the edge, push the envelope on technology, essentially become technology vendors in many respects. But on the flip side, when that backfires, you want to be able to step back and say, wait a minute, I'm a utility, don't come after me, I have limited liability in this scenario. Maybe, Boris, we'll start with you. I can see you shaking your head aggressively. So
I was shaking my head because we believe that part of the focus that all of the exchanges and all of the industry participants are looking at right now in terms of speed bumps, other risk protection mechanisms are in fact a competitive point. And we believe that while we all want to have our cake and eat it too, part of that is by providing our participants the best possible risk protections that we can. We have known this from the very start of electronic trading on the option side, that the better you can protect your members, the more liquidity they'll be willing to show. As far as being under the protection of being a utility and falling back on those rules, I can tell you, at least from the IEC's perspective, that is certainly not how we view our role. We, in fact, focus greatly on protecting our customers as much as possible. And we have made several enhancements over the past several years for market makers, for non-market makers, in terms of risk protections. We're certainly watching very carefully what's going on with NASDAQ and the Facebook situation, and it behooves us to try to avoid as much as possible the reoccurrence of such events, although it's important to know that something like that could have happened anywhere. There's a lot of human intervention, human watchful eyes over all aspects of electronic trading. I think that the media would have you believe that things simply trade by themselves, and that's simply not the case.
Maybe let's boil that down a little more then. Instead, so liability protection, should exchanges have it, yes or no? And if so, why? Boris.
I think the exchanges should have liability protection. I think that exchanges are not set up to be gigantic organizations funded in such a way as to potentially be put out of business on any single day because of a system malfunction. I think that it's important for us to figure out the appropriate rules in place to minimize the damage on all sides.
But if you're a broker, if you're a trading firm, you play by those rules. You're a for-profit entity. If you have an error, you're going out of business, or you're getting very close to that. So why should the exchanges be differentiated from that? Maybe Lisa.
Okay, thanks. I think the exchanges, while most of them are now for-profit, do provide a service to the public. They have obligations to run a fair and orderly market. They might not have as much flexibility as the broker-dealers. We are all highly regulated. Our rules are approved by the SEC. And to Steve's earlier point, put out for a robust public comment period. So I do think, while though they might be for-profit entities, they are providing a public service. And I do think, say, for example, if there was an error that would have put my exchange out of business, well, that would have disruptions throughout the marketplace for other routing, and we provide a niche. We provide a good marketplace for our segment of the customer base. And if we were to go out of business from an error, or maybe a broker was stuffing quotes and it disrupted our system, that would have ramifications to Steve's marketplace and maybe Boris's marketplace, and it would be rampant throughout the options business.
Jeremy, same question for you really quick. Yes, no,
Yeah, so
why?
We should. That limitation of liability is good. And there is a very good, this ties into the last question, separation between that regulatory function that we're providing as a public good and everything else. The options industry, we have this little thing called ORFs, and the regulatory side is not an area where the exchanges compete. The way that the ORFs are designed is this is the cost to effectively regulate the industry, and that's something that's passed on, and you don't see somebody out there trying to more cheaply regulate their members. And so that limitation of liability is tied directly to that regulatory function. It's not an area where it would behoove anybody to have a race to the bottom.
Let me ask, is there anyone who is willing to give up their immunity from liability for financial loss?
I would just note that No, I don't.
Everyone line up right away.
To answer Mark's question, I don't think it's a good idea, and I think there are important reasons why it exists. But Nina, to your point, and this alludes to what Boris said a minute ago. We don't sit as an exchange on a giant fund of money, that's at the ready to pay out in the event of some sort of catastrophic system problem. I mean, like all exchanges, we work proactively to have appropriate levels of risk control. I believe, as I implied, I think earlier, that they should be strengthened, and that perhaps an industry-wide effort working together with the SEC to strengthen them is called for, given some of the events of the last year. But that said, if we were to operate in a world where exchanges didn't have liability protections, I think it's important to observe that ipso facto the cost of trading on exchanges would have to go up dramatically, simply because if you look at the size of the options market, for example, I don't know the number. Somebody in the room probably does, but certainly billions of dollars of premium, of options premium, and a far greater amount of notional is changing hands every day. Some amount of liability protection is required for exchanges to be able to operate markets of that size and scale at the current levels of fees that are assessed to the marketplace.
So let me ask you a question. I'm not sure what you mean by perhaps regulators in the industry should strengthen the funds that are available when an exchange sort of fouls up and has a technology problem. But right now, most of the exchanges are either at $500,000 or $3 million per glitch that's their fault per month. NASDAQ is the one at $3 million. So if you don't think, if you have no issues with the immunity that you have, do you think that the limited liability you have should be changed? Should that be increased? Should it not be a hard number? Should it be dependent on your net income or something else? Like, is there room for discussion there? Because obviously your largest member firms are very concerned about this.
So just to clarify my comment quickly, and then I'm happy to yield. But I was not saying, although certainly I think having a discussion about those numbers is not necessarily inappropriate. But what I was saying specifically a minute ago was I believe our risk controls, or our risk controls for automated trading, I believe should be strengthened as an industry, because that reduces the likelihood that whatever the level of funding that is set aside to meet potential liabilities, it reduces the likelihood that that's actually called for.
Yes, Stevie, I think you read the same wonderful article by Professor Angel speaking to this issue of exchange liability and whether or not it should exist, and he hit on all the great points that he had made there. We're relative to our member firms, small market cap organizations. We process trades for pennies, and the notional value of those contracts are billions and billions and billions of dollars. It's just impractical to have an exchange processor be responsible for the financial repercussions of a product that has that kind of value. But if you did not have those rules in place protecting the exchanges, economics being what they are, all of that cost would eventually flow down through the revenues that the exchanges would have to take on to fund the potential liabilities which they would ultimately be responsible for. So, at the end of the day, the rules in our exchange and everyone else's that deal with liability are, like every other rule in the book, oftentimes reviewed, and as a result of the circumstances that have taken place in the marketplace over the last few years, are always subject to change, maybe even harmonized. We'll see where it goes. But I don't see the exchanges certainly willingly, nor do I see the SEC making the exchanges take away the liability limitations that exist. They may be modified, but I don't see them going away. And they actually serve, I think, a proper purpose.
Well, if you were a member firm of the CBOE, would you think a $500,000 cap is a good idea, or would you rather it be larger? I mean, NASDAQ obviously went to $3 million last year when they had a problem on one of their markets with market makers in the auto quote system.
So, Nina, the rule is what it is today, and I'll say again, that rule, as would be the case with any rule, will be evaluated, and if we judge based upon what is in the best interest of us and our customers that it should be changed, we'll consider that. We're open-minded to it. We learned a lot over the years about talking to our customers, and we learn a lot from them, and if ultimately we conclude it is in the collective best interest to change that number, we'll do it.
Walt, do you want to touch on this? You can just say no.
No.
I just want to hit on that for a second.
I'm not touching this topic with a 10-foot pole.
That issue that Steve and that Ed brought up about the raising of the costs. We hear this in a lot of industries whenever they don't want a change forced upon them. Oh, don't do that to us. It will force us to raise our costs. But in the exchange and options business, how realistic is that? We look at all the other participants in this industry, none of whom have any real liability protection. They've all become more streamlined, more efficient. They've found ways to work around this and still lower costs and still provide a very viable, functional service to their clients and their customers and their end users. So perhaps instead of the opposite, instead of raising costs, perhaps would it lead to more streamlined, more aggressive, more risk-aggressive, I should say, exchanges? Because at the end of the day, really, how much room is there for you guys to pass along costs? Maybe Steve.
That's true. But those participants have vastly higher fees passed along to their customers than we do. You might go execute a trade in your online brokerage account of a couple dozen contracts, and you may pay $40 or $9.99 or whatever it is, depending on the facts and circumstances of the trade. Our revenue from that trade is maybe a couple of bucks, and we're not charging the customer side at all. So the revenue levels and the fee levels and the risks, I think, are different for example, for a brokerage firm than they are for foreign exchange. What I'll say to your comment of a minute ago is I think certainly it's true everyone in the industry has had to adapt to the landscape as it exists today. But the people in this room, the liquidity providers, are savvy actors, right? There are risks, there are risk controls on each exchange. There's an extent to which I think firms, and it is a little bit of a competitive issue across the exchanges, and to an extent I think that's appropriate, look at what kind of protections do I get on this exchange versus that exchange. We just on AMEX and ARCA just this week, as a matter of fact, the rollout was completed effective on the open this morning, introduced stronger risk protections for market makers, for market maker quotes as well as for orders. And any number of firms that we've spoken with have said, that's great. We're aware that you're doing that. We'll increase the size of our average quote on your exchange by 30%. Because those new protections are in place. So we're certainly strongly incented, despite the existence of liability caps and other things, to operate markets that minimize the risks for all participants from a profit motive standpoint. And to the extent that we're able to better compete for that business by having stronger protections in place for all comers, we'll be more successful. And certainly to the extent that our potential downside risk is increased as a result of adjustments in those protections. I think as Ed said, it's basic economics. We would certainly have to assess whether that would impact the costs of doing business on the exchanges.
Maybe before we go back to risk controls, we can just ask one last question. At least I have one last question about the liability issue, which is, especially in the wake of what happened with NASDAQ and Facebook, where you saw the consequences of a decision that some people in the marketplace obviously did not agree with, which was continuing trading without the execution reports flowing back to member firms. How do you see your responsibility as exchanges when something does go haywire, when there is a problem? Has your view of your responsibilities changed in the wake of what happened with NASDAQ?
I can say that while we don't have the inside story on everything that occurred in Facebook, we have been at this for 40 years. We have had our issues over the years both in the days when everything was open outcry and certainly in the more automated fashion. We've learned how to communicate with our customers in times of crisis and probably over the many years have made mistakes and learned from those. And that doesn't mean we're perfect today. We do understand that there was not good information perhaps flowing back and forth in the Facebook situation, and anyone who's been in an exchange control center when there's a massive problem can understand how information may not flow as well as you would like. But we all think we learn from those situations. It's not like I have the blueprint of what went wrong there. I can look at it and make sure that isn't going to happen at the CBOE. But we have lots of people with lots of experience, and you sit down and you brainstorm what could have happened there and how could it happen at CBOE and how would we handle it differently. And so to some degree, I guess indirectly, you learn from other people's mistakes. I can tell you that every one of these situations, and we don't have an IPO type process the way the stock side does, but you try to sit down with your operations and systems people, go through, if you will, a post-mortem of someone else's problem and see if you can come up with ways of how you might do it differently. But boy, I tell you what, every one of these situations is unique, and it's hard to be 100% confident that you won't have the same kind of problem.
Okay, so we've kind of flagged this one pretty good for a period of time, and Walt's down there wanting to talk, so we got to find a new topic. So I'll get him to respond, and I'll kind of chime up that. I'm sorry. Did you have one last thing?
No, that's okay.
No? Okay.
And it's good to sit next to Ed because he can fill,
Right. He's hiding it well from us, though. That's good.
Maybe really quick before we jump off that, really quick, 1 second. I know because we talked about risk controls and the lack of harmonization on risk controls, and there was a lot of interesting disparate opinions on that, and there's agreement that we probably maybe can't harmonize those. Let's drill down into specifics for a second. What about something specific like canceling trades? That seems to be at the heart of a lot of the issues we've seen of late in the marketplace, the handling and reporting of canceled trades and that backlog and how that could impact. So maybe on that specific issue as opposed to entire risk control harmonization, should there be some harmonization on the canceled trade reporting and acknowledgement and processing throughout the exchanges just to make it easier on the customer side?
The idea behind cancel a trade or adjust a trade, I think, is where you're going.
I mean, those things are, should there be harmonization of the, obvious error and kind of like uniform standards amongst the 10 exchanges. I mean, I think we're generally, in favor of that, some sort of harmonization. We're all playing by the same rules to make sure that, the customer experience is the same regarding, errors and mistakes and things that are outside normal trading range. I mean, whether we'll get there or not remains to be seen, but I know, Tom and some of the other exchange heads are kind of thinking about that and taking steps to see if we can get there.
I think Ed hit on it earlier. We all have the same customers. When CBOE has a rule that our customers think is better than the box rule, Tony gets a call and, a strong suggestion.
Goes both ways.
What?
It goes both ways.
Yeah. And, I think it's incumbent of each exchange to look and see if, your rule would fit my marketplace and to see if that's in the best interest of my customers. I mean, the customers do have a choice whether to write to Box or write to CBOE, and if they don't like the disparity or the rule at Box or the rule at CBOE, they can make a choice.
There we go, consensus.
Let me ask you a question about risk controls. A number of you have said that the controls that you have in place for your market makers and for liquidity providers and member firms is a way for you to differentiate yourself and is an advantage that you can have over other rivals to get more orders to come your way. But are there some risk checks and filters that should be mandatory across exchanges so that you could differentiate yourself by going the extra mile, but that there are some things, duplicate trades or erroneous trades or, orders that are a certain distance from the inside market. Are there some things that should be, some minimum requirements that should be required across all exchanges? And if so, what would those be?
Well, there are additional controls, and some of them will go beyond my ability to sit here and describe them, but there's there's limitations on how much a market order can drill through the bid. We call it drill-through protection. I'm sure everybody else has something akin to that. There's a good number of those that exist. Standardization of those across exchanges, yeah, sure. I guess that's a good idea. I don't want to beat the competition thing to death. A lot of those things are developed by each of us because we're highly motivated to give our customers an environment where they feel more comfortable sending us flow. If it's deemed that standardization of some of those protections is good for the industry and is mandated by the government, I'm not so sure that the edge that I get by having those is that dramatic that I would be opposed to that. But there are additional protections in the system that protect certain orders from getting filled at too many prices away from what the national best bidder offer was when it started. And there's others as well, which quite frankly I just don't know enough about to discuss. But you got a bunch of competitors up here who want to take every order that is not at their exchange and bring it to their exchange. And we also, and I believe this, think that there are many areas where we should harmonize. Got to love that word. And yeah, I think you can have both. In the case of risk controls, probably some greater degree of harmonization makes sense.
Do others agree or disagree with that?
I would agree that in terms of reevaluating the recent events and ensuring that perhaps there is some minimum availability of risk controls, which I think all of the exchanges have today. On the other hand, most of those risk parameters today are optional. Most of the exchange participants choose those parameters by themselves or perhaps choose to not make use of them at all. And perhaps there's something in that vein that could be done, not necessarily to harmonize, but to ensure that that minimum is available and that in fact all exchange participants are obligated to at least set those parameters. I can't imagine that we would want to prescribe what those risk parameters would be to individual firms and force firms with very different levels of risk appetite to set the same parameters. But perhaps as just that extra safety check, we should look at ensuring that our members are obligated to review those, to have those parameters, and to actually set those, and that there are procedures in place to make sure that no one's flying blind.
I agree with that. I do think that at least some baseline level of risk controls ideally would be standardized across exchanges, and that more sophisticated controls at the discretion of individual participants could then be potentially a value-added competitive issue. We certainly should not each be bound by sort of the lowest common denominator in terms of some single industry-mandated set of controls that potentially is then only then changed slowly over time. I do agree with Boris that mandatory risk controls are important. We do on AMEX and ARCA have mandatory risk controls for market makers, and in fact, with some of the events of the last year, we reduced the maximum permissible settings for those risk controls to lower levels for all market-making participants, as well as adding additional flavors of risk management. So I think mandatory controls certainly make sense. Someone earlier, I think it was Walt, made a point. I also do believe that there's some level of activity where it's appropriate to require not just a kick-out where quotes or orders are then able to be re-entered automatically, but actually do require an authorized person to make a phone call, a known quantity to make a phone call or send an email to a trade desk and take responsibility and say, yeah, I'm putting my name on the line. We believe our system is operating correctly. Let us back into the market before that can happen, because we've seen over the last year cases where firms have had systems problems, where perhaps valuations were incorrect and there was a false perception of opportunity in the market that led to a lot of activity that shouldn't have taken place. With a systems problem like that, once you get kicked out of the market, you're very likely to look and continue to see opportunity and say, okay, great, let's get right back into the market, keep making all these fantastic trades, when in fact there's something erroneous taking place. So I think that's a very good suggestion as well. I would say that the responsibility for that does not and should not lie exclusively with the exchanges, however. We've seen with Rule 15c3-5 taking effect last year, the SEC is now requiring firms that provide market access to have appropriate levels of control in place. From a capitalization standpoint, size of orders that are being entered, there's sort of a sniff test where if an order comes in that looks very different than the standard for a particular customer, that should raise some questions. And the firms that are providing market access as well do have and must continue to have that responsibility in parallel with the exchanges, because in many cases they know their own business much better than we do. And on that point also, we've got 10 exchanges. I don't know, I have no way of knowing if a particular firm that seems to be sending us a lot of activity may be in a very judicious and prudent way offsetting that activity with trades on Ed's exchange or Walt's exchange or somewhere else.
Okay, we're definitely killing that one. That's the end of that. So we'll move on just a little bit. I mentioned this earlier in the beginning of the panel. Obligations of liquidity providers and do the exchanges currently have the tools in place to require stronger obligations than they've currently got, because the obligations over the years have diminished? And is there enough incentive there for people to quote once obligations are put in the market? Can we provide that incentive? So I'll let maybe Nina or Mark can expand on that a little.
Maybe I'll jump in on this one. I'm a former market maker. I know a lot of people here in the business are former liquidity providers in the room today. So this one is near and dear to my heart, the plight of the liquidity provider class, as it were, in the option space. This is a class that is under assault from all sides, essentially. And Ed mentioned the obligations. I'm not so much concerned about the obligations right now. There are a lot of sticks hitting the liquidity provider on a regular basis. We have taxes, we have payment for order flows, a number of other things that are coming in, making that job much more difficult, squeezing out a lot of the mid-tier and smaller providers in that space, to the point where we're looking at a future where we have centralized liquidity in a couple of very large liquidity providers, and we've all seen how dangerous that can be recently, and then the rest of it is all provided by professional customers. So, and that's not an ideal scenario, I don't think, for anyone. So the question I have more specifically really is, instead of more sticks, what are some of the carrots we can put out right now that are of immediate impact? Let's say you're the proverbial mid-size, mid-tier liquidity provider, and you're on the cusp of just throwing it all away and say, the heck with it, I'm going to become a professional customer. Why should I bother standing in here and making markets and taking risk every day when I could flicker in and cherry-pick the order flow and essentially trade what I want to trade without most of those obligations? I want each of you to give me a very specific near-term carrot that would be meaningful to a market maker or liquidity provider right now. That's something we could do that would maybe incent them to remain a little longer. We'll start with you. Let's start the other end of the table. Walt.
Yeah, I don't, the way you phrase the question makes it seem like, a lot of market makers are leaving the business.
Or have left.
I'd say that's true for the local and the local floor trader. I don't think that's necessarily true for, larger capitalized firms. And we've seen new market making firms come into the Philly venue. There's a couple other market making firms that are ramping up operations, getting ready to come in and quote. And I think they believe there's opportunity. And I think there's, in some cases with the make-take venues, there's opportunity to earn rebates instead of paying PFOF to trade. So I think it's not blanket. It just depends on, how people perceive the profit potential. But I do agree the small local is probably going away. I mean, we see our floor shrinking.
Step aside from the small local for a second. Let's talk about, the mid-tier, because I agree, the small locals are pretty much gone.
One other piece of that is, do they stay during market turmoil? I think that's kind of the whole idea behind, we've got to keep these guys here. And while the options market has been very resilient, we're focusing, a lot of these questions are really focused on the equity markets in a lot of ways, but because we're a derivative of it, it directly affects us. But do they stay during market turmoil? Because I think that's certainly there's a perception in the world that they don't. I don't know that, I'm not saying that's true.
Yeah, I made that perception because more so on the equity side. But, we've seen, tremendous market activity in August 2011. And I think, from at least our market's view, the major market makers are there, and our mid-tier firms were there trading, providing liquidity, and we assume, and I think assume rightly, that the profit potential was there as well.
So it's not broken.
Well, you know what? Let me just say, I think that the market making community in the options business is really the jewel of this business, and one that we are incredibly dependent upon to operate as marketplaces. We have a highly fragmented product, hundreds of thousands of series, all of which have bids and offers continuously in them. Maybe not as tight as people would like, but unlike the stock business where you have several thousand individual names, we have hundreds of thousands of securities, and we know that at CBOE, by our data, market makers are on the other side of most customer orders, and it's very much a quote-driven market, and we need to make sure that the market-making group, the specialists, the DPMs, and the market makers have an economic rationale for staying in the business. I am concerned that over the years we have seen what I have viewed as very, very solid groups go off of the market-making business upstairs, as it were, on the theory that the opportunities to trade as a high-frequency trader or simply a prop shop are just as good as being a market maker, because the opportunities and advantages of being a market maker have been, to a large extent, taken away over the years. So, listen, the combination, in our view, is maintaining the cost environment at such a level that they can operate and interact with as much retail flow as they can. It's to me as simple as that. The bid-ask spreads, having narrowed the way that they have, both through mandate and competition, have made it much more difficult for them to operate as profitably as they had in the past. It may have gone too far and driven too many of these market makers out of the market, taking on roles where they're opportunists and not taking on the obligations. But I think that our strategy is to bring as much order flow to the market-making community and maintain their costs of doing business as absolutely low as possible. And who knows, maybe the SEC's discussion about a pilot for widening spreads will take hold. I wouldn't hold my breath on that, but that has probably been, to me, the biggest issue impacting the viability of the market-maker community as opposed to anything else.
So nothing we could do in the near term then, no specifics that we could hold out these carrots to the market making community saying, here's what we're doing for relief. The current pricing is sufficient, everything else is sufficient right now.
Yeah, I mean, nothing that's so obvious, Mark, that I could throw out, if we just did this, everything would be good. I think that I wish there were something as simple as that. Maybe somebody else has an idea.
I would like to throw something out there. I mean, I think, first of all, we do have a lot of carrots in place for market makers. Professional customers can't avail themselves of the bulk quoting mechanism on our exchanges. On the AMEX exchange, they can't avail themselves of our directed order program. On both AMEX and ARCA, and really I think on most exchanges, market makers are eligible for lower fees and higher rebates. So there are various carrots that exist. Quoting obligations are important. It's great to have obligations that drive market makers to provide liquidity in more issues, but many issues that are out there are very illiquid. I happen to have these numbers in front of me. We've got about 400,000 listed options on AMEX and ARCA on a typical day, and I think the statistics are very similar across all exchanges. Only something like 17,000 of those options, of those series, actually trade. So it's a very small percentage of the listed options that trade in a typical day. As a result, many market makers, simply from a cost-benefit perspective, inevitably will choose not to quote some of those less liquid names. Perhaps additional incentives could be put in place there, but of course that will come at some cost to somebody. What I will say, Ed, in response to your point is, despite those obligations, you really can't legislate someone to stand in front of a steamroller if they're not comfortable doing that, if they think the risk is too great. It doesn't matter what the obligations are. They may make a business decision to choose to get out of the market rather than potentially incur what they believe is a risk of a great loss. So I think what we as an industry need to do to try to mitigate that and to encourage more liquidity provision in those illiquid names, and particularly in those times of market turmoil, is proactively try to take steps to reduce adverse selection for liquidity providers and reduce the extent to which the nanosecond arms race continues to drive up the costs of getting out of the way of highly negative selection-driven order flow that may be coming into the market.
There was kind of three themes I think I took out of that was the things that exchanges can do to continue to keep the market liquidity providers in the marketplace, which is risk controls, bid-ask spread, and access cost. So touching on, Ed, I believe you brought it up, was the Jobs Act, and that the SEC has now been mandated to review a certain number of securities, and of course are small cap stocks, things that have recently IPO'd, stuff like that. And then with that, the results of that study we'll be able to mandate back to a wider tick from a penny over to something, wider, between, I believe, below 9 cents. If they were to do that, that of course would attract liquidity providers back to the market. You get nice wider spreads, higher profitability. What would that do to volume? Would it be good for it or bad for it? Why don't we, Jeremy or Boris or Lisa, you guys haven't had much of a flogging yet.
I don't think artificially wide spreads is something that helps volume. I just don't see it.
Okay.
I definitely think that in some instances, widening the spread, being able to congregate liquidity at distinct price points, I'm not sure that it would be a fantastic thing for retail investors in terms of seeing spreads potentially widen, but certainly in terms of institutional participation, and perhaps with the concert of existing mechanisms available for price improvement for retail, I think it actually could increase volume in some of the lesser active issues today because of the fragmentation and because maybe perhaps some of them should be trading in nickels.
I agree with Jeremy. I don't think artificially wide spreads is appropriate.
Okay. Fair enough. You want to add to this, Mark, or I mean, move on to the next topic?
Well, I guess in terms of specific questions, you're right. I mean, even if we did go back to pennies or nickels in those spreads that are wider, we'll still see, payment and price improvement kind of tightening those spreads. So I'm not sure if at the end of the day we would see that much of a dramatic thing, even though it is, I think, at least a progressive step to see finally that they're looking at the quote-unquote penny pilot, and I wish we can just get rid of that term. It's not a pilot anymore, is maybe inappropriate for certain names and certain classes. And maybe perhaps at the end of the day that could provide some modicum of incentive to trade those less liquid names, because you're right, no professional customer in this marketplace right now is coming in and actively trading those less liquid names, and yet there still is a viable incentive to push those out there. So anything we could do, I think, to make that more of an attractive proposition for these firms that are standing in there trading them is I think, a beneficial thing for us.
Yeah, I would challenge a little bit, I think, the notion of an artificially wide spread. I guess I'm not sure what's meant by artificial. There are a couple of names, SPY, the Qs, and IWM right now that trade entirely in pennies. I for one, would certainly say that the fact that many series still trade in nickels and dimes is very appropriate, and it's not artificially wide, although it's wider than a penny. There's no benefit, in my opinion, to churning up market data for no reason by having market makers quote a $300 deep in the money Apple call in pennies. And walking up that bid and offer a penny at a time all day. I think that drives up costs for the entire industry. It does increase adverse selection for market participants who are attempting to quote competitively in a series like that. So I think certainly wider markets in greater pricing increments and either in less liquid series or in very expensive options, I believe is very appropriate and in the best interest of the industry.
Let's kind of going on this theme a little bit of kind of going back in time along with wider spreads. Often I hear people say, years ago we didn't have these market interruptions. This stuff didn't happen. Again, I'm just making statements. I don't pretend to believe in a lot of that. Is that true? Could we go back? I mean, a number of you operate floors, a number of you don't. We've got the whole criticism of high-speed markets, evil data centers, things like that. Are they as important? Is speed and access in that rapid rate or that HFT rate as important in the options business as it is in the equity business? And do you ever see a time where that access to speed starts to get regulated, so to speak?
Yeah, I think the potential exists for regulating in that you can make the case that the way exchange data centers are set up is certain parties may get greater access depending upon their proximity to the trade engine than others. So there's always the ability to, get within the technology and try to make judgments as to whether the market participants are on an equal footing because someone's got a longer extension cord from the trade engine than the others. But I don't buy into even though we'd all love some of the elements of the way markets operated earlier in our careers. In fact, maybe the market could go back down to the floor. But it's not going back. The markets we're going to fix the problems we have. I can't tell you exactly what all the solutions are, but we're going to fix the problems. The problem is not, slowing everything down. It's dealing with the ramifications of what has become a high-speed, not fully electronic, but highly electronic marketplace. Like every industry, it has its bumps in the road, and some of those are pretty big bumps. But I think that as an industry, we've faced challenges like this throughout the years, and we've continued to grow. I have no doubt that that's going to continue to happen. But I don't think there's going to be dramatic, going back to the way things used to be in any respect. High-frequency trading is not a huge part of our business. Maybe it will be in the future, but it certainly hasn't shown itself the way I define high-frequency trading. And if it does, that'll be another set of issues we'll have to deal with. But I think that the markets will continue to evolve. And quite frankly, I think electronification and speed will be an issue for us for the balance of the times that we're active in the business.
Okay. Well, I don't mean to cut the other panelists off, but we're running a little bit out of time, and I want to make sure that we open it up to the audience for questions. Do we have any? There we go. Joe's hand is up quickly.
It's Joe.
This is where I need my suit.
Limited liability of exchanges is relevant and of grave concern, so thanks for discussing it. It's been exacerbated by the lack of rules to deal with trade problems. For example, if I send you an order and you mishandle it, and I call you and say, customer's entitled to a better price, the answer you get today is, well, you're right, we did mishandle it, but there's nothing we can do. We don't have a rule in place to deal with it. Are any of you considering rules to address catastrophic failures at your exchange, considering that we all dynamically hedge, and breaking trades without addressing hedging would pick winners and losers?
Well, I won't go into the specifics, Joe, other than to say that, again, as we always have, when the industry faces situations as it has over the last year to 18 months, actually going even farther back than that, you look at the issues and you think, what if it were us? And what if it happens at some point in the future? Do we have our rules and procedures in place to deal with it? So I would say that is a constant source of evaluation, and I won't sit here and tell you that specifically we're working on one aspect of the issues that you raised, but it is something that we spend a lot of time on.
Anybody else?
Yeah, I think the rule filing process is a little more tricky than some people might realize. The SEC wants you to have rules that cover each specific instance, yet you're kind of playing catch up. You might be writing a rule for the last problem that happened, and you have to be also forward looking to try to encapsulate other type issues. To your point, Ed, when something happens on another exchange, we all, get together and do a post-mortem of what may have happened on the competitor's exchange. So you try to craft a rule that will deal with that, but you can't always project and understand what the next crisis is going to be or the next problem. So you've got to keep your rules very specific, broad, blanket. Liability rules don't seem to be the norm. The SEC is very interested on exactly what this would cover and what circumstances you'd implement it. They want to make sure that your marketplace isn't treating different participants in a dissimilar manner. So it's a challenge.
I think, and I agree with both Ed and Lisa and Joe. I don't have a good answer for you other than to also say that it's definitely, as Ed says, a constant topic of discussion, and we have rules in place. I think that the obvious error rules, for example, they have harmonized somewhat over the years, but as Steve pointed out earlier, we don't have identical sets of members, and opinions are different. One of the things that I think this highlights, in addition to the discussion we had on limitations of liability and some of the things that Lisa just pointed out, is how prescribed the relationship of the exchange is with its members, how specific everything that we do is. We operate in many ways very differently from our members, who, while also existing in a very regulated industry in how they deal with their customers, have far more latitude in how they treat their customers, how they address specific situations, errors, technical issues, the fees that they charge. That's not to say that this is why, in fact, limitations of liability are important, but it is one of the aspects of an exchange's role and how different we are from our members.
Joe, just to add one specific point on your question, I think regarding the risk incurred by particularly liquidity providers who are hedging transactions, we are of the mind at NYSE that we would like obvious error rules that result in an adjustment as often as possible and in a bust as infrequently as possible, with the idea being that the risk is at least controlled in cases where someone receives an adjustment rather than a bust, given that they may have made an offsetting transaction. And so we are in the process of reviewing our obvious error rules on, as Ed said, on an ongoing basis, but also at present specifically with an idea toward moving more toward an adjustment rather than a bust type of regime.
Okay. Any more questions in the audience? I have at least one more out there. No? Okay. Well, I would like to thank the audience for being here. Our panelists, I do have to apologize because I realized I didn't introduce Nina and Mark at the beginning, and they, of course, were a very big part of the panel. They were the core of the questions that came to everybody. And one thing that I noticed, I think, from this panel as opposed to many of the others that I, in fact, sat on with many of these participants, is that each of the questions, the panelists answered them more as an industry and more as in, these tumultuous times, what we're doing as an industry to fix a lot of this. And they didn't try to redirect every question of how their own exchange is handling it. So for that, I give the panelists a lot of credit as well. So.
Just one big happy family up here.
That's exactly right. We're all going to go out for a big lunch afterwards. But again, thank you very much to everyone. Give them a big hand.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.